Bitcoin, the Bitcoin price relative to gold, the gold price. You can see it broke out at the end of last year. It's testing now. We have seen the gold price go up recently, and the Bitcoin price, while it broke through 100 to, I think we got to 108,000, it's come in a bit, and makes sense that it'll be testing a breakout. As you know, we believe that the Bitcoin price has miles to go.
Cathie shares optimistic projections for the cryptocurrency, underpinned by its evolving role in financial markets. She notes that Bitcoin's price relative to gold has broken key resistance levels, signaling further potential for growth. Her team's bold case projects Bitcoin reaching $1.5 million per coin. While this may seem ambitious, Cathie ties it to Bitcoin's increasing utility as a technological asset class rather than merely a store of value like gold. Moreover, she anticipates Bitcoin may eventually find its way into U.S. Treasury reserves, further solidifying its position in the financial ecosystem.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
One of the other anti-inflationary forces out there is the dollar. Now, if you take out what happened in the early 80s, which was actually a very deflationary period, especially for emerging markets, you can see that we're heading up towards the high end of where the dollar has been over the last 40 to 50 years. So this is a powerful anti-inflationary force, and it is another reason that we expect inflation to continue to unwind during the next year to 2 years. Now, on this next chart, you can see money growth in the purple was negative for quite a long period of time. It moved into positive territory last year. We're still at a very low level by historical standards, roughly 3.5%. You can see inflation in the green line. It broadly, there is a correlation with money growth. Now, the big controversy right now is, are we stuck at this 2.5–3% range? We do not believe that we are stuck there, and that the big surprise will be much lower than expected inflation, thanks to productivity gains, thanks to the dollar going up, and thanks to monetary policy that has been quite restrictive. And I think Chairman Powell still describes monetary policy as restrictive. So inflation typically follows money with a lag. And we do think that we will see more gains against inflation. And we're still saying we would not be surprised to see some negative numbers out there. How could we get those if money growth is turning around like this? Well, we would get that if the velocity of money slows down. And it has been slowing down. And I think the uncertainty associated with the transition to a new administration could be one reason for velocity to slow down, taking any expansionary power away from this money supply growth. Bitcoin, the Bitcoin price relative to gold, the gold price, you can see it broke out at the end of last year. It's testing now. We have seen the gold price go up recently, and the Bitcoin price, while it broke through 100 to, I think we got to 108,000, it's come in a bit, and makes sense that it'll be testing a breakout. As you know, we believe that the Bitcoin price has miles to go for all kinds of reasons that we will delineate in our big ideas report, our Big Ideas report, will be out in a few weeks. And in that report, you'll see how we get to our Bitcoin price forecast. We are in print, the bull case being 1.5 million. And while we have changed the way in which we get there, we do believe we're going to get there, especially given this administration's sponsorship of Bitcoin. It may even end up as part of Treasury's reserves. So if we're right also that the gold price is unlikely to move out of control in the inflationary environment, meaning disinflationary environment that we see, then Bitcoin will be responding more to its role as a technology and a new asset class than to its role, like gold, as a store of value. And it should continue to pull away from gold in the years ahead.
Cathie addresses the debate over inflation and market valuations, comparing the S&P 500 to gold. Skeptics argue that inflation and interest rates could undermine valuations, echoing patterns from the 1970s. However, Cathie disagrees, emphasizing a shift toward disinflationary conditions driven by policy and economic trends. Similarly, she examines the relationship between the S&P 500 and oil prices, noting that despite geopolitical tensions, oil is not soaring as it once did. Increased U.S. oil production could further weigh on prices, benefiting equity markets.
The yield curve has been very interesting. We've featured it ever since we started these in the No videos because it went negative and stayed negative for a very long time. You can see here in this chart well, first let me explain what the yield curve is for those who don't know, who haven't been tuning in. It's the difference between the 10-year Treasury yield and the 2-year Treasury yield. And typically, longer-term interest rates are higher than short-term interest rates. And when they are not, when the yield curve inverts, it's usually a period of very tight monetary policy that leads to a recession. So if you look at the shaded areas on this chart, these are the recessions, and you can see that they are associated with inverted yield curves. The yield curve inverts, and then we go into a recession. And it's happened pretty much every time, even pre-2020. I remember in 2019, it's hard to see here, but it did invert for a time. And we thought it was inverting because inflation was so low and long rates were more focused on inflation and responding to that, whereas short rates were responding to economic activity. Well, we had COVID, and so we'll never know the answer to that if we would have avoided that recession. It looks like technically we have avoided a recession. Now, the closest we've come to this is in 1989. Now, we did end up in a recession then of the S&P 500 versus the S&P 600. 600 is, or that group, it is the small and mid-cap group. And you can see since really the peak in 21, the S&P 500's EPS are up 10%, but versus the peak for the S&P 600, earnings are down 50%. And of course, this is the reason that the market has concentrated so incredibly towards just a few, a group of stocks, the Mag 6, the Mag 7, whatever you want to call them. And we do know that the rubber band is stretching for these smaller companies if they get any relief from whatever measure. And I think deregulation could be the surprise here. Regulation tends to protect larger companies. They're pretty entrenched and they have great lobbying groups. Smaller companies don't. So I think that deregulation is going to unleash more animal spirits, and we'll probably see the earnings of smaller companies start rising relative to larger companies in the years ahead, especially if, again, this administration does help engineer lower inflation and interest rates. Those who believe that we are going to have a problem with inflation and interest rates believe that this metric, the S&P 500 divided by gold, is peaking out now and is going to roll over much like it did during the 70s. We disagree with that, as I think I've made clear. And you can see the market is trying to figure this out. It's in a holding pattern here. So we're watching this very carefully. And here is the S&P relative to oil prices. You can see on this score, the S&P is winning. Historically, boosts and soaring crude oil prices have led to recessions. They are not soaring now. And in fact, with what's going on in the Middle East, it could be with Iran not sounding as inflammatory, perhaps, that there will be a different attitude as this administration takes office once again. And we would submit that oil production in the U.S., if we do get that extra 3 million barrels, is going to weigh on the oil price going forward and be good for the S&P 500.
Cathie Wood concludes her analysis with a cautiously optimistic outlook. She envisions lower inflation, enhanced productivity, and policy-driven market dynamics shaping the financial landscape in the coming years. From Bitcoin's transformative potential to the resurgence of small-cap stocks, her insights offer a roadmap for navigating these complex yet promising times.